And now we'll start taking a look at charts of interest. All right, so the one we've been talking about the most today was Procter Gamble. Okay, so the first one I look at is Procter Gamble. And we're just going to look at these on a daily basis. I love this posture here. I like that it's been in this tight trading range here for about 10 days after this long period of selling when price collapsed. It's had 10 days to fail further, and it hasn't. And it's made a nice triple bottom here around 75-ish. And we get 2 dots on the parabolic stop and reverse, which means we should be thinking about the upside. And so I'm ready to go long on this one around 76 with a stop down here around 75-ish or 75 and a quarter. And then my targets are going to be something like, let's see, I would be looking for a return to the edge of the river, then the 90. I would be looking for a return to the Bollinger Band mean, which would kind of close the gap on this large selling. If it can get through these 2 different resistance levels, then that becomes reasonable. And then the far objective, of course, would be this return to the RL 270. So I like all those setups there. You're buying this one on relatively low. This is a low risk idea. If it fails below your initial stop line around 75 and a quarter, let's just mark that there. Then this is an auto short simply because it's been beat up so much. That would give the signal that it's a resumption of whatever caused this original selling pressure. So that's what our trade frame looks like on Procter & Gamble. That would be a bread and butter setup for me. Next we want to let's look at Healthcare Xlv, the strongest of the strong sector spiders. This is not bad. It's finding support at the bottom of the river. Let's see here. So it's finding support along the bottom of the river. It closed well. We can buy it here. Our targets would be Bollinger Band mean, RL 90, far side of the river, and a return to the RL 270. I think you can get short this one, though. If it fails below that low, it will have violated an important double or even triple bottom. And then, even though that's the strongest sector, you could tolerate that idea. I would be very cautious doing so, just because it's been so strong. But I still think people look at this as a buy on dip opportunity. But I want you to notice that there have been some days when there have been some very large range moves to the downside. And so while I'm optimistic on this one to the upside, I'm cautiously optimistic. What I would like to see is the market to have a good day, healthcare to have a better day. Then I feel like I can own that one more safely. We're going to shift now to let's look at Brazil. Perfect. We're still in the swing trade on the short side on Brazil, where we got short here. We're still owning this one. And you know, the stop on this one is above the dragon, and basically just using the north skin of the dragon and the PSAR all the way down, whichever one of those is north, has been keeping us in that trade. And so we're short at from about 30.75 on $1.50 risk, and we're at 26.29, and more pain to follow. The only positive sign on this one is that it had an opportunity to fail Friday, but guys are willing to hold it with a higher low over the weekend, much like this one. But every other time it's done that, it's collapsed. So the play is still to the downside here. If you do end up getting in this one on the long side, the scenario would be the S&P is strong and Brazil is stronger, and so you're looking for a one-day pop on that one. This is not one that I would hold long overnight. I would be willing to hold this one short overnight, however. So that's Brazil. And let's do Home Depot. That was sort of that stealth relative strength trade. I'm going to pull this back and look a little further into the past. This is what 4 months of outperformance looks like, generally speaking. The last time it had a big pull away from its RL270, I just want to show you this. That was the RLFF framework there. And here, in both of those instances, and really, let's see, there's another one here. Every time this that RL10 pulls a considerable way away from the RL270 and then starts to hook back up, I want you to just notice that there's been a nice positive move as it tries to get back to its RL270, and that's sort of the basis of that fractal framework. So you can think about trying to capture this move, some of this move, some of this move, and this move. Now price is getting actually pretty close to its own RL270, so there may not be much room left, but right now there's certainly some complacency in here. Now if this were to fail, we would expect the Bollinger Band 270 to hold, so 116 is kind of the downside. Anything between current price level about 120 and 116, this is all noise. And so if you're on a swing trade, the first price that tells you that the upward trend may have cracked is a failure below the Bollinger Band mean. Now you may not want to hold the $4 risk on that one. There would have to be $8 on the upside. In the absence of resistance above, I think you could own this one on a swing trade, even if you were starting now. My preference would be to get it back when the RL10 turns, but on all other things being equal, on an intraday trade, if you have the market is up and Home Depot is better, you can own Home Depot as a low risk idea for one day, and then maybe try to grow that trade with the accumulation of intraday gains and convert a portion of that into swing trades, so you can get a low risk swing trade entry there. I have time for one more, and I want to look at Treasuries because that has also been slowly improving. Even while the U.S. conservative defensive trades have been working, Treasuries have actually been working too. And you can see here just why that's so interesting. Treasury's putting in a nice big fat bottom down here around 118 to 115, and has had a nice move all the way back up to its RL 270. Really, and then the next price level that matters on that one as far as resistance is going to be this one around 130. So there's actually about an 8% move inside Treasury still available. So my scenario for loving Treasuries would be something like this: that all of the other equities in the world have been collapsing or crumbling, especially Brazil and the emerging markets. Oil is still deconstructing a lot of economic engines worldwide. Only the U.S. large caps in the defensive areas are making any kind of sustained moves. If that collapses, then the run in equities is done, and so the next flight to quality there is U.S. Treasuries, and so that's the argument to me why Treasuries can get to 130-ish, 132 on a technical basis in the next couple of weeks. If they collapse, then it's certainly back down into the 118 area down here, and then I would expect that to hold. Okay, so I got to get ready for a coaching workshop right after this one. So I'm going to, that's the last one I propose to frame. If you have any specific questions, I got a couple minutes. But otherwise, I'll get this processed and hung on the website and get ready for coaching. Ridwan Lothar has posted a nice executive summary of the week from the chat room. He and Curtis have taken on that project, and they're doing a great job of highlighting the essential discussions and making a nice condensed Reader's Digest version of that for our use. So I would encourage you to look at that if you get a chance. Other than that, you guys take good care, and we will see you in the chat room.